It's one of my themes here. It's the flow of money. It's what makes the world go round. Credit is what makes the world go round, not cash, credit.
Get ready for a new episode of KP Talks Dollars and Cents. Learn financial literacy and get real-time updates on all things housing, finance, and real estate. So let's get started. Here's your host, Kevin Perenio.
Hey, it's KP coming to you live from Corona, California. What a day in the markets. I have a lot to talk about, so bear with me. This feels like COVID. This feels like 2020 when things were crazy and people had to get a handle on what's going on. I'm looking at screens over here. They got a bunch of reds, and the stock market, one of the biggest single-day sell-offs in history. It was the biggest single-day sell-off with the Japanese, the Nikkei index, the Japanese stock market. They had two rough days in a row. The yen, the value of the yen was actually strengthening, and that means the yen carry trade blew some stuff up. Some Warren Buffett, sold half the Berkshire Hathaway position in Apple. We had, bad news last week. There's so much that's going on here. And so this is going to be a pretty involved video. So just bear with me. I may have even been looking at my notes a little bit instead of trying to memorize everything because I don't want to miss anything. It's such an important thing. I actually last week was like, you know what I'm going to talk about? Happy uninverted yield curve day. That's what I was thinking. We were really close last week for the yields of the 2-year Treasury coming down so much that it actually would be lower than the 10-year yield. Now, that's important because typically when it happens, that means, you're about to be in a recession. And that's a big indicator. We've been in an inverted yield curve where the 2-year yield has been actually higher than the 10-year. And that's weird because people expect a recession or really hard times in the short run. That's why the 2-year, has that higher yield as opposed to the longer term 10-year Treasury. We almost got there to where, it uninverted, not quite. Instead, we had a blow up, and it had a lot to do with the flow of money. Now, we talk a lot. It's one of my themes here. It's the flow of money. It's what makes the world go round. Credit is what makes the world go round, not cash, credit. So, for example, if there was $1 trillion in cash in the entire world, there's $50 trillion in credit. Well, some of that credit is borrowed. Some of it is levered up. There's lots of leverage there. And sometimes when these trades unwind, it spreads, and that's called contagion. And that's what we saw in the stock market today. I am not, thank God, a financial advisor. I am not responsible for your losses, only your profits. Now, I'm not going to say buy the dip today because this may not be over. And I'm not trying to be scary or create, some kind of worry. But every time we have a contagion in the financial system where there's gaps in liquidity or trades unwinding. Remember the guy that traded with like 5 different, broker dealers all under $100 million, so he didn't have to report it, right? So this 13F form is what you have to report when you have $100 million in assets. And this guy who was like he was like a Tiger Cub, a protege of the Tiger Fund, which blew up, by the way, in 2000 on a yen carry trade. This gentleman, he borrowed like $100 million, from this house, Goldman, Morgan, Chase, and he made all these levered bets on CBS stock, and it blew up when the value of the stock went down. So, very similar type thing happened today with the yen carry trade, and I'll explain why that's important. Because we buy and sell money in our business. Yes, we put people in homes. Yes, rates are coming down. We're going to put a lot more people in homes. Rates are coming down. Affordability is getting better. It's a huge driver in our business, huge tailwind. But if people are looking at their stock portfolio and it's going down, at least on paper, hopefully you didn't sell in a panic today. Don't panic. I'm not panicking. I'm trying to keep you calm here. But I will say there was some craziness in the market. So a very popular trade around the world, especially amongst hedge funds and institutional traders, is to borrow very cheap money, which the Japanese yen, their currency, has been at 0% for like a decade or two, right? So you borrow with that, and then you go invest in something else like Apple stock or the Magnificent Seven stocks or real estate, or you buy dollars or whatever the case may be. So all the central banks around the world, who, by the way, are meeting in Jackson Hole at the end of the month, which is a big deal, could be an announcement coming from the Fed. They like to leak out news at Jackson Hole, Wyoming. It's where central bankers from all over the world converge. They talk about what's going on. And we've always talked about here on my podcast, basically, that the central bankers move in concert. They move together. Well, Bank of England's cut. Bank of Japan raised. Bank of Canada cut. We're about to cut, haven't cut. Everyone's basically cutting, except Japan raised. Well, why? Because they've been at zero interest rate, even negative interest rate. They have this thing called yield curve control, and they buy a certain amount of their own currency to kind of help strengthen the yen. They've been trying to get their currency stronger. And so they raised a quarter basis point. So 25 basis points is what their central bank raised their currency. Everyone else is cutting. Now, remember what happened when we raised the Fed funds rate in March of 22? Our stock market started tanking and interest rates started going up. Well, this happened this past week in Japan, and it carried over into today. People were emailing me and texting me and sending me messages in the middle of the day yesterday on Sunday asking what I thought, is going to be World War III and the Japanese carry trade is blowing up and all these kinds of things. And I think, I'll just, instead of read my text, basically what I wrote in the middle of the afternoon yesterday was, cash is king again. So all asset classes will sell off when there is some kind of big, huge dislocation in the market, when liquidity is a real problem. And that's what we saw. I mean, everything sold off. Bitcoin was selling off. People were, if you're shorting a position and you're short the yen, and the yen strengthens, which, is what happened there. I mean, when central bankers raise the rate of their currency, it strengthens that currency. If you are short the Japanese yen and you've got trillions of dollars around the world invested in stuff, and the yen strengthens on the back of a Japanese central bank raise, just like we've been having rate raised here, well, that will cause people to have to cover the shorts, which means they got to sell this, sell Apple, sell Bitcoin, sell their NASDAQ, sell their options, sell gold, sell the house, sell the farm, and they got to cover their short position. So we see a lot of indiscriminate selling, and it may not be done. And we may find out tomorrow a couple hedge funds blew up. That's what happens. That's what happens when they take these risky trades. Yours truly, I realized losses today. Now, I have a little investing account. It's a trader account. So I have my conservative fund where I invest, and I don't need to look at it. I haven't looked at it today. And, it does what it does. My good friend out there, Keith Mickle, he's out there, Carrera Advisor. He's the man. So Carrera Capital Advisors. That's conservative. I'm not worried about it. Then I got my little handheld where I do my trading, and I'm a little levered up in there, but it's fun. It's like my little gambling itch. Well, I woke up this morning at 6:30, and Interactive Broker was selling off some positions of mine to right-size my over-levered account. So I woke up to some realized losses. Sucks. Took an L. That's okay. I took somebody out earlier this year to fund some of my construction projects. So you win some, you lose some. But, so I feel like I'm immersed in this. So what the hell does that have to do with the price of tea in China, right? Well, the flow of money is a big deal. And if we are talking about a recession now, and we're getting closer to a recession, is the Fed behind the curve? The 10-year Treasury went as low, the yield went as low as 3.68 this morning, something like that. 3.68, but then came back to about where it started during the day, like around 380, 379. So I think it ended at 385 even after hours. So the market wants to continue to go lower. It wants to continue to have lower interest rates. But why did it go back up at the other day? Well, there was actually some good news. Some ISM, global news, and services jobs were created here. The ISM services employment number. So there was actually some good data that came out. Now we got Fed speakers the rest of the week. So what are they going to say? What are they going to say when people are saying we should be cutting now and we should do 50 basis points now? I just watched a clip on CNBC with Wharton School of Business professor, economics professor Jeremy Siegel. He said they need to do 75 basis points now and then another 75 at the September 18th meeting. That's not going to happen. I think that's overdone, but we got 5 weeks to go to the next Fed meeting. And like I said on my last video last week, which I did 3 videos last week because it's one of those kinds of times where things are very volatile. Things happen fast. They break quickly. People recoil. You remember how quickly rates in February of 22 were at the lowest in the history of history and ramped up into the high, mid 7s just by June. So March, April, May, June, just 4 months. It was so quick. Everyone sat back and said, you know what? I'm going to wait for home prices to come down and I'm going to wait for rates to come down. And the rest of 22 was brutal. It was a very slow. People do the same thing with their spending. When they see, their stock market, blow up, their portfolio go away, right? So I saw some 4 shapes. Someone sent me this thing. It said hexagon, polygon, some other, decagon, and then it said portfolio gone. And it was like a red graph with the number, the red line going down. When people see that, they don't feel as rich. They don't spend as much. They recoil. They don't buy more durable goods. They don't buy more stuff. They don't spend on travel. And that is what a recession is. So the SAHM rule, SAHM, we've talked about that quite a bit. It's an indicator, a statistical regularity, as Chair Powell said last Wednesday. It was triggered. It's basically Claudia Sahlm's rule, who is an economist, used to work, I believe, for the Fed and some other places. We're connected here on LinkedIn. If the unemployment rate rises half a point, 50 basis points. So like, for example, we went from 4.8, we went from 3.8 to 4.3. So that's 50 basis points in a 3-month period. Goes up very fast in a short amount of time. That's an indication of a impending recession. So these things feed on themselves, and we may not be out of the woods where bad news means bad news. We have a chance, however, for more data to come out this week to maybe calm things down. August 11th next week, the CPI number comes down, inflation. Everyone's talking about employment, but inflation. But that volatility, there's a VIX number. There's this volatility index, which basically shows the ratio between puts and calls, betting up and betting down the market. It spiked up today, hit the highest number since COVID, hit 60. So people panicked. There's a little bit of panicking going on. Germany, risk of double dip recession right now. That's Europe's largest economy. So, we're going to find out, trade deficit information tomorrow. How are we doing there? Is there conflict in the Middle East, which, obviously impacts the price of oil and global trade and all that kind of stuff. The manufacturing index went down last week. Unemployment numbers were not great. The unemployment number rose. Even though about 70% of the jobs lost on the Friday jobs report last week were jobs being lost in part-time employment. It's both good and bad, right? Like, okay, it was only part-time employment, but wow, we have a lot of part-time employment, as opposed to like full-time employment. So, jobless claims rose last week. Bank of England cut rates for the first time in 4 years. But then, of course, we talked about our expanding workforce and the numbers that came out this morning that helped stop the 10-year yield from going down. Okay, that was by the way, that was the Supply Management Services Index. It rose 2.6% from to 51.4%. That was the good news today. That somewhat stopped the bleeding, at least in the U.S. bond market. Employment. It said that employment grew for the first time since the beginning of 2024, with the sub-index rising 5 percentage points from the prior month. So that was good for employment in the services, Supply Management Services Index. So you can go check that out. The survey commentary and the index seem very consistent. The expansion indicates a growth in GDP, which we just did have a 2.8% GDP Q2 reading. So not all is bad. So I don't want to get everyone caught up in the moment. Try and relax and stay at about a 6 as opposed to a 10. I'm working on the 10-6 rule. Thank you, Steve Scanlon. By the way, of those jobs that were created last month, there was only like 117,000. They were in healthcare and in construction. And what was interesting is I saw Logan Motoshami, Housing Wire analyst, say something about unemployment isn't really a problem until construction jobs are being lost at scale as well. Every house that's built creates on average 4 new jobs. Well, construction lending has been largely privatized. And so it's a little bit expensive. I know, I pay the damn rates. And thank God they're going to come down too. But, construction has held up because there are more builders, mid-level and smaller tier builders. So we're also undersupplied. So anyway, I could go on and on and on. But let me just say, don't panic. Tomorrow's a new day. Rates are down. It's really good for our business. Have a wonderful evening, and I'll get another video out later this week. Cheers.
You've been listening to KP Talks Dollars and Cents, a top-rated show for those who want to learn about the economy and mortgage environment. Tune in each week for more episodes, and please leave us a 5-star review on Apple Podcasts and Spotify. Kevin Perenio does not render or offer to render personalized investment or tax advice through KP Talks Dollars and Cents. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. For more info, follow KP Talks Dollars and Cents on all of our social channels.